All right, Happy New Year. Back with Jeff Carter of Points and Figures. Jeff, Happy New Year. Hope everything's sitting well in Chicago after yesterday's football game.
Oh, yeah, it was great, wasn't it, to watch the Packers beat us? I hate the Packers. It was to be a Midwesterner over the New Year was rough, you know. The Big Ten was sailing along, and then New Year's Day happened, and it got off to a rough start.
Well, at least you're fighting Illini. We're one of the bright spots down there.
We won. The two I schools won.
I know. I won.
So maybe... at the Alan Schoenberg roast, I was joking with Eli Radke. I asked him which bowl Indiana was going to play in, and, but maybe they would have won because they were an I team. I don't know.
Exactly. All the I teams won. Well, anyways, let's talk a little bit about an article you wrote today on your blog, Points and Figures, Speed, High-Frequency Trading, Markets, and the Money, kind of in response to a article in the New York Times today, which we both agreed didn't offer a lot of new insight, but your blog...
Really didn't.
But your blog did indeed offer a lot of thoughts and insight. So why don't you give us your thoughts on how the rules and regulations are changing and how the markets have changed, and maybe these rules and regs are too late to the game?
Yeah, I think that your second point is correct. I think the New York Times article, what it did was it was basically fear, right? Oh my gosh, this electronic machine is doing everything, and it's not in New York anymore at the New York Stock Exchange. It's in New Jersey with those dirty people over there and, blah, blah, blah. But it didn't really talk about what's really happened to the marketplace. And I think there's a very healthy debate going on about that. For instance, I had 3 academics tell me I was wrong today. All of them University of Chicago PhDs in economics and finance. But academics never traded in a pit. So,
exactly.
That's my argument is I always saw guys stealing off the top step. I saw guys trading against the deck. And that's essentially not what the high frequency guys are doing, but that's what the SEC world is doing.
Right.
So, as orders come in, they're basically front running and able to risklessly arbitrage against all kinds of markets and makes free money that nobody else can.
Explain that to maybe the viewer who doesn't understand what you just said in real simple terms.
Yeah. Well, that's one of the problems with the blog post too. Is it's way too long, but it's impossible to talk about this in real simple terms. So the easiest way might be to take a hypothetical order. Your order on E-Trade that you enter to buy 1,000 shares of Citibank, let's say. That's a very highly traded, highly churned and burned stock.
Yeah.
So that order comes in, and let's say you put a price on that order. It's going to go to a trading desk. Let's say you're using an E-Trade account. It's going to go to Citadel, because Citadel buys order flow from E-Trade.
Right.
So more than likely it's going to go to the Citadel trading desk, and they're going to look at that order and say, can we make money off this order by selling to them and buying cheaper somewhere else. Yeah. And maybe it's only a penny, maybe it's 2 pennies, maybe it's 3 pennies. It's probably not much more than that. Might even be a half cent. The spreads are incredibly tight. But with the payment for order flow and the payment for liquidity, it screws up, in my view, the risk-reward ratios. So that the risk now is on the person that's providing sort of the orders to the market, the order flow to the market, and not on the person who is supposedly providing liquidity to the market. And in the old days, the liquidity providers are the ones that assumed all the risk, and they got all the rewards when the market went their way, and they took a beating when the market didn't go their way. And so I think that's all been turned on a dime in the SEC world for sure.
Right. So, what does that mean, do you think, to the retail guy who's no longer on the floor as yourself and you're upstairs trading? And, how does that affect the little guy that's still out there trying to fight the machines and the quants and the HFTs?
Yeah, well, the little guy doesn't have a chance. He's going to get screwed over. Every order that he puts in, when he gets into the market and when he gets out of the market, he's going to get screwed over.
Yeah, so essentially what's happening, Jeff, is, those, like you said, the Citadels of the world are getting a peek behind the curtain
Right.
And even though it's a penny here, a penny there, nickel here, nickel there, it adds up because they can take that balance of, and the computers can see all those orders so fast, match them, make the money, and the retail guys, as you said, left out in the cold going, what just happened?
Right. And it's not just Citadel. I don't want to pick on that.
No.
It's any big bank, it's any big major hedge fund that has access to a dark pool and pays for order flow. And can internalize it. And so I think in the last week, the interesting thing to me was the fact that BlackRock decided to begin to internalize all their customer order flow, which was a first.
Yep.
And it'll be interesting to see what happens to them, if there's any retribution in the marketplace behind closed doors, because they still have to deal with banks. It'll be interesting to see what PIMCO does, to see what Fidelity does, to see what Vanguard does, to see what all State Street, all of BlackRock's competitors, and see if they start to internalize their order flow, because what that's going to do is make the market even more fragmented than it is today.
Right. And so, volatility and liquidity, what happens?
Well, I think, you could make an argument that there is more liquidity, less liquidity. I don't know. It seems like we're trading more volume, but the volume doesn't seem like it's good volume. It's just churn and burn volume, which, who cares? But the volatility is much more enhanced, I think, in these types of markets than it would have been, let's say, 5 or 10 years ago. And the problem with me saying that is I don't have any data sets in front of me. It's just a pure gut feel, and so I can't prove it. It's a pure gut feel. You see these markets run around, especially the thinly traded ones. They just move on a dime, and they don't trade through prices. And it seems like we have a lot more mini flash crashes than we ever had before. We had, of course, the flash crash at May 6th. I think the day after Christmas, we had a flash crash in Europe on the open. So it's a consistent theme that keeps running through, and it just happens that, there's dark pools, there's internalization, there's payment for order flow, and I don't understand why everybody just doesn't want to, get out on the same field and compete,
Right.
If they're so much better than everybody else, they should be able to compete on the same playing field. That's my argument.
So that leads to my next question. If everybody is jumping on the same boat, it's probably doomed, since they're all trying to play the same game, maybe it counterbalances the edge that they perceive that they have, and it ends up dissipating and being eliminated.
It's possible. I think, it'll be interesting to see how it evolves with BlackRock starting to internalize order flow. But I think the other thing to remember is that it's not just in the cash equity market that this is taking place. It's in equity options. It's in the currency market. It's in the muni bond market. It's in the corporate bond market. And so the big banks really, my friend Ira Harris likes to call them like the five families. They have a stranglehold over the supply. And so if you try to start up another exchange, you're going to get slapped down. You're just not going to get any supply. Yeah. And you're not going to be able to trade it. You're not going to be able to make good markets. And the markets, as you get into like muni bonds and corporate bonds in particular, are extremely murky. They're not transparent at all. It's very hard to even find a price.
Right.
And in the cash equity markets, one of the things that they always had was you could always find a transparent price, and now the New York Stock Exchange quote is probably not the best price. It's in some other place in some dark pool somewhere. That's where the real market is trading. It's almost like, there's the wholesale market and the retail market, and the average consumer is paying retail all the time.
Yeah, it's like like you said, it's a level 3, 4, and 5 that retail. Retail. They all have 2 now, and nobody can see 3, 4, and 5, which is, as you suggested, controlled by a limited group of dark pool players who get to see the order flow before they make it. Their computers make the algorithms, and they're picking up pennies in the corner, but on the flow, it's a lot of money.
It's a lot of money because you're talking about how many millions of shares trade each day, and the other thing that I think people need to realize is this stuff happens faster than you can blink your eye. So these computers and these algorithms that intermingle with the dark pools and the broader markets, they can do that faster than you can blink your eye. So it happens so fast. For instance, in the lean hogs the other day, I wrote a blog post about it. We had a 250 lot stop rally the market 170 points. It would have never happened in the old days. It would never have happened. It might have rallied 30 to 50 points, but it would never have rallied 170. Well, it was a 250 lot stop order, and it turns out that about 1,100 contracts traded in that 170 point range. Well, you never saw them trade.
Right.
Because it happened so fast.
Yeah. Well, and I even look at wheat Sunday night, and it was a 2% gap. I mean, you'd never see that on a Sunday night especially without any news, any event. There was no major locust, movement. I mean, there was nothing happening. No. It was crazy.
There was nothing happening, and I think you're seeing that more and more and more. And the increased volatility, what it's going to do is it's going to chase a lot of people away from the marketplace.
Yeah, and
eventually you're going to have a. Pardon me?
I agree with you, and this is where. So my question to you: the volatility is scary now, but eventually, as it has happened in stocks, goes away. There's volatility, yes, in commodities today, but I think eventually it goes away. And I think that, in essence, is really you've got the banks playing into the Fed's hand. The Fed wants decreased volatility. Mm-hmm. Because that provides them the leverage to do what they need to do, which is print more money and do the things that they continue to do. And I agree. I think not only small players, but I think big players are leaving these markets because of what we are talking about right here. They're afraid. Right. They can't.
Well, I mean, if you're the CFO, I always go back to the flash crash because that was so scary. If you're the CFO of Anderson Consulting and your stock's trading $44 a share and you're trying to do a financial plan, a 5-year plan based on your stock price improving at some percentage that you imply, but it's probably not going to be any worse than $44 a share, and you look up and your stock's trading 40 cents, what do you do?
Right.
I mean, it's just not, that's not how markets work.
Yeah.
And right now the market on the SEC side is totally corrupt. And it's corrupt not because necessarily of the players that are in it, but because of the effect of bad regulation. And DoddFrank, as much as heralded as that bill was, didn't do anything to fix the marketplace.
Right.
As a matter of fact, it made it worse.
I agree. And I think so. The next step then, because I think even I was at a few holiday parties, and even some of the doctors there said the same thing that you just said. The DoddFrank bill has done nothing to supposedly fix the problems that it was built. Even they are seeing that. People that aren't day to day in the markets, like you and I, see the fraud that is being implied by this whole new regulation. It's not fixing anything that was broken pre-Lehman. No. I mean, what's going to stop? Let's say Lehman 2 happened tomorrow. Pick a bank. Why is the market not going to crash? Of course it's going to crash. And I'm not against crashes. I think markets sometimes they break and sometimes they rally. But I think the thing that you want is you want a level playing field of competition. And, right now, you don't play a high school team against an NFL team. And the reason you don't is because the NFL team is going to crush the high school team because that's the way it is. They're so much better. And they've got a different game, da-da-da-da-da. In this case, I think the little guy can compete with the HFT guy and the banks. He has to change his trading style. But, you can't be like I used to be in a pit trading in and out and out and out. You have to change your trading style. But at the same time, you want a level playing field to be able to do battle on because you have no chance if the playing field's against you. And right now it is. Right. So give us some suggestions, opportunities that you think can, let's not leave it all doom and gloom. Let's throw some positives out there that you think would help level that field again for all participants.
I think in the SEC side of the building, The one thing that's proven itself, I think, in the last 2 to 4 years for sure, is the theory of efficient markets that Fama proposed. And so the one thing you do is don't pick a single stock. Just buy the S&P or buy a sector if you want to have a little more beta risk, and ride that sector in a dollar cost average, and you'll make money over time. I don't think it's a stock picker's paradise. I don't think the market ever is a stock picker's paradise unless you have more information than the rest of the market. If you do, then, invest in that stock. But make sure it's not insider trading.
Yeah, no, and to go along with that, I think there are opportunities still to be had in the futures and the commodities, the forex space that small traders can still benefit from. And I think
absolutely.
I think you're starting to see a major shift of folks, moving to that space, because I agree with you. Stocks haven't moved for a long time in a normal way. Really, I'll go back to 02, 03 that they really began to, tighten and less volatility. So the opportunities to speculate and provide edge have to come in places where there's still some movement. And that still, to me, does look to be, although we talk about these hyper crazy moves, hey, we can take advantage of that as traders and make some money.
Well, yeah, and I think, if you want to trade equities, there isn't a better contract to trade than the E-mini at the CME. It's computerized, it's liquid, you can get in and out. It's better tax advantages. I mean, it's the best thing going. Treasuries at the CBOT, currencies. So there's plenty of stuff to trade. You don't have to trade, for instance, hogs. I probably wouldn't trade hogs on the screen because it's just too thin. I wouldn't trade coffee, cocoa, cotton, lumber, all that stuff. Yeah. Lumber. Yeah, it's just too thin, but the grains could be a great trade. I think where the individual trader, if they can do it, they should trade options because it's a call-around market, it's a request for quote market, it's a different style of trading, and it's one that you can survive over the long term with rather than futures or stocks. I think if you can trade options, I would trade them rather than the other stuff.
All right. Well, good comments, Jeff. I appreciate it. Great article that you posted again today, so I just wanted to get your comments and post it out there live in real time.
All right. It's good talking with you, Matt, and I hope Harbaugh gets the Michigan job, sort of.
I really wanted to see in 05 when I was railing on poor Lloyd Carr, which I wish he was back today. I wanted Jimmy to come home from San Diego, but our former AD really screwed that one, and now that the momentum trade is all on Jimmy Harbaugh, I just don't see it happening.
I know. Well, you got to get rid of the existing coach first.
Right.
He has to get fired.
I agree, and believe me, I'm with you. I want it to happen. Heck, I would have taken Les Miles, 5 years ago.
Bring back Gary Moeller.
I would bring back Gary, but he's 70 years old.
I know.
Gary Moeller ran out of there like a freight train, and it was a sad story because he was a great coach. Yeah,
he was a good coach. He didn't do well at Illinois, but he did well at Michigan.
Yeah, he did.
Anyway, well, Harbaugh's probably going to win tonight, so
that game's
may stay in Stanford.
Kicking off. Although I wouldn't want to play Virginia Tech right now. I think they're playing some good football.
They are playing good football.
So
Harbaugh's a pretty good coach.
Yeah, he's a great coach. We'll see what happens after tonight, and we'll have you back on here as soon as we get some more good market stuff to talk about, which, of course, we will this year. So,
all right.
Happy New Year.
Well, take care, Matt.
All right. Thanks, Jeff.
Yeah.